Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. We're here to discuss today a very important aspect of the top event risk that we have coming up next week, the FOMC rate decision. How many times have we come into major event risk over the past couple of months? Namely, I think one of the best developments was the non-farm payrolls, very fresh on our minds. We go into this event risk and it has a high probability from a fundamental perspective of moving the markets, yet in the end it doesn't necessarily generate a lot of that short-term volatility. That's an important consideration and probably the most important means of our of short-term trading as we debate how this event risk will cross the wires. Now, we know that there is a lot of potential in this particular event. It has been a very remarkable and very prevalent headline. We've seen a lot of discussion about it. We've also seen a lot of price action. However, that price action is not evenly distributed. And we want to see the probability that we will have a big move in the US dollar, the S&P 500, or US equities, perhaps even gold and treasuries, and really go down the list of what markets will and will not be market moving. Will there be a immediate impact? Right? Potentially, if there is that September taper, would it be enough to actually spark a risk aversion move? Would it spark a rally for the US dollar? Or perhaps, as many expect, a lot of this is already priced in. It's very difficult to fully ascertain how a market will respond to event risk. It all depends on how it actually crosses the wires. Perhaps there is no taper versus actual taper, or perhaps the discussion is going to evolve into what their pace will be beyond the first move, or maybe it's going to be whether the first taper in September is going to be 10 versus $15 billion reduction. All right, these are the kind of considerations that we have to take in. And I think one of the more important aspects of this is, yes, you have to assess what the actual outcome is, because we know that there has been a lot of speculation leading up into this particular event. This is and I will keep bringing this up, the New York Fed Primary Dealer Forecast Survey. These are the banks that are required to purchase treasuries at the normal dealing by the U.S. government. We also, and you can see that they have an aggressive forecast. They expected in September or next week that there will be a $15 billion reduction in the monthly QE3 purchases. A little bit more loosely associated is the Bloomberg Economist poll and Reuters Economist poll as well, where they are showing a very high level of certainty that there is going to be a taper at this particular event. But those assumptions have not been an equal opportunity impact on the market, and we can see that actually in the comparisons of the different markets. All right, this is actually a measurement of the U.S. dollar, the carry trade index, the S&P 500, and U.S. 10-year yields. And what I did was I set them equal to September of last year, it's approximately a year, and seen how they developed since then. We've seen some very dramatic reactions from the markets, as you would expect from taper fear, but it has not been very consistent. Right? Now, a more isolated and concentrated look at this. This is a lot of different assets. All right, we have dollar, we have S&P 500, we have mortgage-backed securities ETF, we have the Treasuries ETF, we have carry trade as a measure for general FX positioning, and we have gold. Now, I've made this chart, this is based upon price action, and I set them all such that starting on May 1st, and that's when the U.S. Treasury markets really started to take off, and we've seen that this has been really the most sensitive of the asset classes to the Fed taper conversation. I set them such that as they move, as you would expect to adjust for taper expectations, it would rise. Right? So with U.S. equities, you would expect taper to lead to a risk aversion sentiment, and thereby it would drop. And subsequently, I've set that drop so that it would rise as well. So positive means that we are expecting taper in that asset class, and negative means it's ignoring it. All right. Well, you can see that the S&P 500 is perhaps the most remarkable and standout asset class here. All right. You have gold and you have treasuries, which have been perhaps the most sensitive to that taper speculation. You do have some significant positioning in mortgage-backed securities and carry trade, and even the dollar is in that taper position, but it's not very far along. But standing out is the S&P 500. That is where my expectations are lying going into this particular event risk. Now, a lot of that taper speculation has been priced in. Otherwise, you wouldn't have seen the forecasts from the Fed primary dealers. You wouldn't have seen the Reuters poll and the Bloomberg economist poll forecasting a September taper. Or you wouldn't have seen Treasuries take their massive drop or the yields rise so aggressively. Clearly, there is some level of speculation. It's probably baked in. However, just because those expectations are there does not necessarily mean that the markets have already adjusted for it. Now, taper is a very concerning thing for the equity market particularly. All right, we've seen that there has been a substantial elevation in capital markets that has been based upon those expectations of ongoing stimulus. All right, what does stimulus do for these capital markets? It reduces the expectations of volatility. The assumption is that there is less volatility in these markets. All right, so as this Fed balance sheet rises, the purple line, you can see that fear falls. All right, I flipped it upside down, so it's more one-to-one. And you can see that those assumptions of very low risk are there. Now, just because you reduce or taper the stimulus does not necessarily mean fear is going to come back in. But when you pair it against something like extreme positioning in risky assets, high leverage use, and 15-year low levels of participation, that kind of exposure is very, very risky. And just the general backdrop of the market is more risky than what these indicators, these volatility or these expected volatility measures are implying. So there is a natural higher level of volatility or risk that we do not see right now because it's discounted on the assumptions that there is an external factor keeping that risk at bay. We reduce the stimulus support and it starts to potentially lift volatility. And we know what the relationship between volatility and the S&P 500 is. All right, it is a negative correlation, which I flipped the VIX upside down once again, and it is a big threat, a very visible threat to stability. Markets where investors are assuming that there is little to no risk of a negative move against their position so that they can continue to really use leverage and place themselves in positions that are of extraordinary risk, trying to make whatever return they can get their hands on, because they have to force themselves into these positions given how low the yields are. And those yields are low because of stimulus. All right, so if there is a risk aversion move that has not been fully accounted for, which I do think that there is a very high probability of, it might not happen immediately after the confirmation of this event. You should also watch for the Bernanke statement that comes out 30 minutes after the rate decision, because he will further define the pace and how aggressive they may become, or he might tell the reason why he didn't move if that is the outcome that we do have. But you will likely see a risk aversion move sooner rather than later. Now, if we have a risk aversion move this next week, expect that priced-in taper aspect of many assets to turn into further discount, particularly for the U.S. dollar as a safe haven currency. All right, once we get that risk aversion move, it will fill in a gap for sentiment, and it will absolutely act as an individual generator of risk aversion move, and you will see the U.S. dollar likely rise. All right, so this is going to be a very important piece of event risk. I will cover it more fully in the weekend wrap-up video, but do make sure that you go into this piece of event risk with a firm expectation that it's not going to be clean. it will be some there will be some nuance here, and we will have to measure not just an individual market's reaction, not just FX, not just the equity markets, but we have to take the entire picture. We have to see how these capital flows move. But one of the most pressing and important aspects of how this event risk impacts the market is going to be through risk trends. Right. Good luck trading out there, guys. I hope you have a great weekend, and we'll make another Forex strategy video next week.